This just happened. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the world isn't prepared for what just happened in China. And you're not going to believe what's going on there and why policymakers around the world are telling Beijing they need to do something and do it now. Because it's not just what's going to happen to the Chinese economy that matters. It's how it's going to have a negative impact all across the world. Now let's over to Bloomberg, where he picked today's story up with a headline: China's Lunar New Year pork gloom exposes deep economic trouble. You might be wondering, why does pork matter here in terms of China's economy? Well, it matters in a big way, because what happens in China ultimately spreads around the world. Now, we keep hearing that the U.S. economy and parts of the global economy are immune to these effects in China. The reality is, as you're going to see here in a minute, they're not immune at all. But in Beijing's Xiamen market, the vendors are struggling. Though pork prices have fallen about a fifth compared to a year ago, the vendors are selling less than a third they would allow during a normal holiday season. So not only do you have deflation and disinflation in consumer prices for food in China, you have demand absolutely crashing there. And this is something we can start to look at what's happening around the world's economy, and we see that China is one of the first countries that gets the end effect of this, because as demand from around the world goes down, well, you see internal demand in the world's largest export economy start to drop, because if consumers there have less income, well, that means they have less money to spend. And the reason they have less income is because the global economy is slowing. And pork demand has been sluggish for months in China, but its continued weakness, even as the country approaches peak season for elaborate meals, sends a powerful message about consumption and oversupply in the world's second largest economy as wage declines, this is a key point, hit households and weigh on consumer prices. Now, what did we just talk about in the show yesterday? That wages here went up in the United States. And many said, well, this is partially a fact because the minimum wages have gone up in some states. But what was the counter effect that we pointed out? Hours worked declined, and not a little bit, but a massive amount. And this brought total compensation for the U.S. economy down in a big way. And of course, this backfeeds all into food prices, and this is the same effect as what's happening in China. The difference is we can see it today in China. We look at the U.S. stock market right now, we can't see it, but it's actually in the data. And here you can see the global price of food indexes showed in blue against total compensation of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees here in the United States. That in red, both on a year-over-year rate of change. And what we're seeing in China is the same thing we can see here in the U.S. data over time. The total compensation growth goes down. Remember, China had a problem with food inflation, and all of a sudden now it's coming down. And you can see this effect again in the early 2000s, as total compensation growth was slowing, food prices were rising, and ultimately they had a big correction. Again, during the global financial crisis, again, as the global economy was headed into a synchronized recession in 2014 through 2016, we know that total compensation, food prices came down, and now it's happening again. And you can see this big drop in total compensation here on the right, that despite the fact that wages went up in the U.S., but hours worked just again got crushed, suggesting that food prices are coming down. Now, that might sound like great news, because that means inflation's coming down, and that means the Federal Reserve will get to their target and perhaps even cut rates again, and everyone will be super happy. The problem is, it's the ultimate, it's the denominator here. It's total compensation is falling. And if it's going down, it doesn't mean just food prices are coming down. It means everything else is coming with it. It's been very difficult to raise prices this year, even though it's already close to the Lunar New Year. And this is a big problem because demand for pork should be very high this year. And what I've heard from a lot of people say, well, we're going to continue to see inflation here in the U.S. no matter what. We're in an inflationary cycle. We've had 30 years of disinflation. We're going to have it. It's going to go up no matter what. In the end of the day, it's all about demand. Businesses do not continue to raise prices if nobody's buying. And this is exactly what we're hearing in China, is they're saying, look, we can't raise our prices because demand's falling. We can't even sell what we have. How can we even think about raising prices? And that's how the downward spiral of disinflation eventually turns into deflation, which again is coming to America. And here you can see hundreds of kilometers away in eastern China, pork supplier Gongcheng is also wringing his hands. Previously, migrant workers who are pillars of the local construction and textile industries would have some 1,000 yuan, or about $140, to spend on pork to make sausages for the season, he said. Now they spend just 300 yuan. Or nothing at all, because it all comes back to the economy. And we look at what's happening in China's real estate economy. It's a mess. The property developers are insolvent, pushing the banks into solvency. Beijing's trying to stimulate the heck out of this thing to get building going on. And look at these migrant workers. They don't have the money to spend. And if they don't have money to spend, prices ultimately come down. Again, a sign of a weakening economy. It's adding to China's worrying deflation picture. And again, we have to remember what happens in China spreads to the rest of the world, because China, as the world's largest exporter, again, second largest global economy, they export deflation. When people buy from them, again, you think about what's on the shelves here in the United States. Made in China, made in China, made in China. Well, if prices there are going down, it means prices here are ultimately going to have the same effect, because food makes up 1/5 of their consumer price index, and pork in turn is a large component. Consumer prices fell in December for a third straight month, and declines are likely to extend in 2024, with, of course, the U.S. Consumer Price Index likely to follow. And all this will do is get all of these central elites around the world telling Beijing, you need to stimulate, and you need to stimulate now. Because even here in the U.S., food prices are coming down because consumers have less money to spend. And that backfeeds right into the consumer price index, just like it does in China. Here we have the CPI shown in blue against the consumer price index. The one in red is just food only. You can notice the relationship there, obviously quite strong. There's some exaggerations because food inflation can get out of hand. You can see the CPI is more of a smoothing effect, but notably, what do we see? A continued downward trend in food CPI, suggesting that the headline CPI is likely to follow in the months to come. And again, it all comes down to the fact that consumers here have less money to spend. And due to the fact that they have a lot of debt, which is typical at the peak of expansions, also at the same time, usually central bankers have raised rates, so their cost to service this debt goes up, means they have less money to spend elsewhere. They have to trim their budget somehow. Again, ultimately leads to lower consumer prices. Yet bouts of stock gains spurred by stimulus hopes have only lasted a few days there in China, as weak economic data soon poured cold water on the optimism. Of course, what's going on with pork prices isn't going to actually help matters at all. But at some point, there's going to be a massive opportunity to invest in Chinese stocks because they're so beaten up. And we've talked about in the past, and when they get down to these low levels, the last time this happened, it rallied over 50% in 3 months. And many of you said, Steve, can you make it so easy for us to find out when these signals happen? Well, here's the first preview report. We got this for Friday, put this out to our subscribers so they have it. Here's what's coming. We hopefully should have it finalized by Monday for both reports. You'll get a daily buy list on your CTA report that shows you which signals are moving and on which ETFs. You don't even have to look at the rest of the report. But let's talk about what's going on in China. This off today's report. We'll have an update on this for the weekend on Sunday, and we can see the selling side is moving down in the machine positioning. And we know the machines move the market and have the capability in a big way, often front-running large moves. This is why, as an investor, you need to know the machine positioning. And more importantly, because we run historical overlays when it gets to an extreme. But here's the good news. In the future, we're just going to tell you when the move happens. Of course, you'll get the rest of the report on top of that. Same thing now with our Momentum Timer Pro. Many of you said, can you just tell us the highest value signals? Put them on the first page. Well, now you've got it. That's going to happen. Here is, again, a sample from Fridays. Let's take a look at FXI. What's going on in China? Momentum has swung now back to the negative. So this is resetting from a trading perspective. If you're a trader and you're seeing this, you're like, great, now I got to reload and get ready, because again, the last time it got down here, it took off. So you want to look and wait and try to find entry points and control your risk And now all of a sudden, you're going to have one of the best tools in the market available to you. There's links in the description. There are 3 coupon codes for a free month. I know some of you have tried it and said, I'm waiting for this. Hopefully on Monday, I should have the report, able to generate the reports myself over the weekend here. That means you're on to you on Monday. Jump on those while you can, because they're going to go away quick. There's only 3. Now, China's criticizes the IMF growth outlook, calls to boost their confidence as the Asian giant is facing high levels of uncertainty. Now, this is exactly what I mentioned. When you start to see an economy enter deflation, consumer prices falling. So what do we know is likely to happen in the future in China due to falling pork prices is, of course, we know that consumer price indices around the world are lagging. And so that means eventually these lower pork prices will backfeed the CPI. There'll be more deflation, more calls from central elites around the world to stimulate that economy and do it with urgency, because uncertainty surrounding China's outlook this year is high. And remember, where China goes, the rest of the world is going to follow. This, according to the IMF and its annual view of the world's second largest economy, referencing a deep property slump and weak external demand. Of course, we know about weak external demand because the rest of the global economy is slowing and headed into recession. But the issue is the property sector has got people spooked, on top of the fact that we know that wages in China are going down. So you have a double-edged sword here. And what that means is consumers are going to start retrenching, building up their savings, paying down their debt, just what they always do. And our authorities' assessment of the recent Chinese economic developments is more positive than the statement claimed. China's experienced a subdued recovery. This from the IMF's executive director from China. In fact, when we look at China's effect on the global economy, as I mentioned, when they export, they do it in terms of inflation or deflation. This time, you see producer price index, economic activities total for China in red against the U.S. consumer price index, both on a year-over-year rate of change. And what we know is producer prices are in contraction in China, likely to head lower because internal demand is weak and external demand is further weakening. And what that means is downward pressure on the U.S. consumer price index. Again, exporting deflation just at a time when we're hearing from central bankers thinking, hey, we got it. In fact, on Sunday, you're going to hear from Fed Chair Powell on 60 Minutes. He's going to do victory lap after victory lap of how he navigated the first ever no landing of the economy. The Goldilocks scenario brought inflation down, and it's going to continue to fall without impacting the labor market. But remember, when demand continues to fall, labor eventually goes. And much of the consultation was focused on the property sector and local government debt issues. This from the IMF mission chief for China. And what we recommend is continued monetary policy accommodation, exactly what I said they're likely to do, and a fiscal policy that would shift spending towards households. Exactly. You got to get household spending here because they're not. And if you want to keep your economy from getting into a deflationary spiral, what's important here is to note that China is not responding fast enough. There's going to be a lot of criticism about their economy in the future from central elites that says you did not stimulate, you did not look at the data, you were heading into deflation, and you did nothing. And what you ended up doing is dragging the rest of the world down with you. And we think there needs to be more done to put the housing market on a path toward a smoother transition and smaller size. Authorities should accelerate the exit of non-viable developers. It means shut them down, merge them, get rid of them, increase the financing to complete pre-sold but unfinished housing projects. Well, that would be great because people that bought them would love to have them done, and allow a greater correction in prices. Now remember, when you think back to the global financial crisis, when housing prices come crumbling down, well, there goes your economy. It just gets obliterated. And of course, now we're hearing, hey, they need to bring prices down in China. No, you don't. You need to get demand back up in a big way, maybe by not building so many empty buildings. That might be a good start. And fundamental demand for new housing in the country is looked to fall almost 50% over the next decade. This, according to the IMF, suggesting, as we know, and many of us know from all the stuff we see in China, they continue to build properties and towers that have nobody living in them. Eventually, this is going to come back to haunt them. This could be the time as their property sectors, we know, insolvent. Banks are insolvent. Their economy is in trouble. Global economy is in trouble. At some point, we're going to find out that there is a big problem under China's housing market, and they could cause their whole economy to implode. But one person who thinks that the Fed is actually potentially going to help the incumbent president get reelected. Says, hey, if I was president again, I would not reappoint this guy. Well, that's former President Trump's comment about our current Fed chief. Trump says he would not reappoint Powell as Fed chair if elected. The question is, would this be a good move or not? Well, I'll let you decide here, and let's see. Former President and likely Republican nominee Donald Trump reiterated Friday he would not reappoint Jerome Powell to the head of the Federal Reserve if he's reelected, saying the chairman was looking to lower interest rates to help President Joe Biden return to his position. And this seems to be something I hear, from people talking about politics or talking about real estate, that, well, it's an election year, the Fed's going to lower rates. That's not how it works. And even if it did, let's just say the Fed does lower rates ahead of the election. How many people would actually know what it does? The answer is they wouldn't. All they would see is their savings account rate would drop. That would not change materially anything about the economy. Of course, that's the myth of central banking, that the federal funds rate actually does something. Of course, we know it really doesn't do much. But he said, no, I wouldn't, Trump said when asked about keeping Powell after his term expires in 2026. I think he's going to do something to help the Democrats if he lowers rates. And I can tell you, Mr. Trump, lowering rates is not going to help Democrats at all. In fact, if the Fed starts lowering rates, it means our economy is in deep trouble. If anything, that would help your chances of getting elected. And here you can see real gross domestic product in blue, showing on a year-over-year rate change against federal funds rate. We can note that when the Fed starts cutting, it's not a good sign for the economy. It means the economy has already started to slow down, which we can predict is likely to happen at the end of the year. Of course, right around the time of the election, we should expect to see the Fed aggressively cutting rates. So indeed, if the Fed starts to cut, of course, the belief here is that the Fed nailed it, and they're going to cut and they're going to juice the economy. Not how it works. The Fed always, when they start cutting, it means the economy is slowing down and heading into a crash. That is why, if Fed does start to cut, watch out below. And that's why the stock market was doing so well if the economy is in bad shape under Biden. Trump said traders were optimistic he would return to the White House. I don't know if that's the case or why the market's up. I think the real reason here is people believe in the no landing effect and that the economy is going to boom here. That doesn't seem to matter by who's president. He said, because I think I'm going to be elected, he said. And most of the recent Wall Street rallies have been fueled by bets that the Federal Reserve is going to start cutting rates soon. Investors piling into tech stocks buoyed by the booming artificial intelligence sector. The reality of the story is people do believe the economy is going to boom. And if you believe that, and you believe the Fed's not going to have to cut much, maybe only 2 or 3 cuts, and then that's it, that's a new neutral rate, well, then stocks is where you want to go. The problem is, when the Fed does cut, it's never good for stocks. As you can see here, the Wilshire 5000 price index against the federal funds rate. When the Fed starts to cut, everyone gets excited that they're going to cut. Then they find out they're cutting because the economy is in deep danger. And sure enough, that means the equity markets come down. And right now, everyone's driving stocks to new all-time highs under the talk that the Fed's got this thing nailed. The reality is they don't. But at least we'll talk about this, Mr. Trump. Even the IMF agrees that the Fed should wait to cut. It's not the fact that Jerome Powell is always late. It's because central bankers are always late. They follow the data. Problem is, Mr. Trump, the data is always late. That's how it works. We use lagging data to make policy decisions. Here you see the IMF chief says Fed rate cuts are better late than early. The head of the International Monetary Fund said the Federal Reserve and other major central banks face more risk by easing monetary policy too early rather than too late, but stressed the Fed shouldn't hesitate to cut rates when the data, keyword data, says the time is right. Central banks need to be guided by the data, not exuberant expectations of the market, suggesting that the equity markets are front-running what is an early expectation. At this time of the cycle, there's risk of premature losing, suggesting that, of course, that means that inflation comes back if central bankers cut. Of course, we know that's not going to happen. Georgieva, who said the time of the Fed easing is likely, quote, a matter of months, says the fund sees the risks are higher from a premature easing rather than being slightly late. She cautioned that the holding rates elevated too long risks both slowing the U.S. economy too much and harming emerging markets, that lowering rates by impacting their currencies in somewhat negative way. Don't keep it tight if you don't need to. Of course, the whole notion here is the reason the Fed is, in their own words, they went too far. So they've got to back it off to get to what they think is neutral. The problem is, what we know is when the Fed cuts, consumer price index comes crumbling down, and we know the CPI is a great proxy for demand. Here you can see in red, federal funds rate generally leading downward trends in the consumer price index, suggesting that as inflation falls, what's happening in China is going to be a problem. But don't worry, no matter who's in charge of the Fed, no one's going to respond in timely fashion, because here you see Fed's Bowman says she thinks it's too soon to consider lowering rates. And how about Goolsbee? He said he wants to see more inflation progress, suggesting they're following data. Well, the problem is, all these Fed people do not understand the yield curve. Terrible timing mechanisms, but great predictor of what comes. We see inversions in the 10-year, 2-year yield curve shown in blue. Anytime it's below that horizontal black line, well, what follows is massive cuts by the Fed, as we know, because what ultimately happens here is when you constrain the creation of credit and you drain money out of the economy. Because remember, we're a debt-based economy. When principal values of a loan get paid off at a commercial bank, money's destroyed. Not to mention, we're constricting the creation of credit by restricting the banks from lending. Well, eventually, everything grinds to a halt. And that's why, Mr. Trump, you actually want the Fed to cut rates, because when they do, it means we're headed into recession. And the odds say, well, an incumbent president never gets reelected under that condition. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.